you always have to sell what's doing best. What does that mean? That means in October last year, you're trimming crypto. That means in the last 3 weeks, you're trimming your semiconductors and your Mag 7 names because they've run up so much. And it's honestly quite hard to do. So forcing the investor to take advantage of the benefit of diversification by having two separate stacks, two separate exposures that have diversification benefits, and harvesting that diversification benefit has been extremely valuable.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to the Bull of Wall Street. My name's Talley Leger, Chief Market Strategist of the Wealth Consulting Group, and I'm flying solo today as a host, but I'm very happy to introduce and welcome a new guest, David Dziekanski from Quantify Funds. Welcome to the show, David.
Thanks so much for having us on.
100%. So I'll tell a little story. I know I'm connected to your COO, Dan Lee, through LinkedIn. And it sounds like you guys are fans of what we're doing here on the pod. And so we just got two ends to meet here.
Yeah, we definitely watch your material and excited to be a guest on the show. So thank you.
That's great. And in fact, I'm happy to report, in case you didn't see, this is good for everybody, not just us, but we've been nominated for an award through Wealth Management for this pod, one of the best investor pods. So you're in a good place, David.
Well, congratulations. It's very much deserved. And I hope you guys win that.
Thank you very much.
Let's give them a reason to give you the medal on today's show. So
yeah, exactly. You're doing your part, right? So let's grow together, as they say. So I want to ask you kind of a general get to know you question. And look, you're a veteran in the ETF space, and we talk to a lot of ETF providers. I used to work with one. I still have a lot of friends in business. But and correct me if I'm wrong, but at Quantify, it seems like your entire business is built around this notion or the idea that most portfolios are inefficient. And I can believe that, and I can attest to it working with advisors and clients and trying to kind of sort out overgrown gardens. But tell me, and I don't want to lead the witness too much, but in your own words, what's the biggest mistake that advisors make when constructing portfolios today? And I want you to talk about, like return stacking. What is that? The fallacy of diversification, and we have to wrestle with that constantly, and alternatives, ETF innovation, all the above.
Yeah, so as you alluded to, our first three products are in the realm of return stacking or portable alpha. So I'll just briefly explain what that is first. This is not a new concept. This is actually a concept that's very, very prevalent in the institutional world and one of the fastest growing categories in the ETF wrapper. It's new to the ETF wrapper as of 3 or 4 years ago, but it's not new to 40 Act products. The first stacked product was actually a mutual fund from PIMCO in the 90s that's still around. You might recall the PIMCO Stock Plus Fund, right? Okay. So in that essence, they stacked stocks on top of a bond portfolio. And in its simplest essence, what is return stacking? It's addition without subtraction. Right? There are assets that you might think have positive return and benefits in a mixture with the rest of your portfolio, but you might think it might actually be a drag against your benchmark. And this is sort of, as I alluded to, addition without subtraction. So instead of subtracting something against your benchmark and underweighting it to make room for something, instead you stack it on top. So it's a way to do leverage that doesn't necessarily need to be a daily trading vehicle. It's a way to do leverage and embed diversification. And to answer directly your earlier question, what do I think advisors sometimes miss? I think sometimes they don't take enough risk, honestly, for their clients. Because to really maximize the risk you're taking from your clients, you end up getting super concentrated in one asset. So the advisors that have a lot of risk on for their clients, you look at it and you're like, okay, you're 90, 95%, 100% equities. Like, you've done very well. But what the math actually shows, that if you add a little bit of leverage, where you're not adding concentration to the same thing and you're diversifying, 130% exposure portfolio oftentimes can have higher returns and less risk than an unlevered portfolio. And it's really allowing advisors to do what the institutional world has done for a long time. Traditionally, advisors are stuck within this construct of just 100%. So to get more aggressive, they have to get more concentrated. And they don't have room in their portfolio for diversification. But what institutions do is they find their optimal mix of assets, and then they add a little bit of leverage to that basket. And that's really difficult for the financial advisor space to do, mainly because it's really hard for a model provider to run using leverage on the models when every client might have a different margin rate. If you have a client with a 5% margin rate versus a 7% margin rate, it's a very different question as to the viability and use of that margin and leverage in their portfolios. So this is a way to prepackage kind of like a lower vol asset with a higher vol asset and force that diversification. And I think that's the other thing, whether it's retail or the financial advisor space, everyone knows they need diversification. They might own different assets, but that's step one. Step two in actually harvesting diversification is actually doing the blocking and tackling and the rebalancing between those assets. And whether you're a seasoned professional in the finance world or an individual running your own assets, it's really hard. You always have to sell what's doing best. What does that mean? That means in October last year, you're trimming crypto. That means in the last 3 weeks, you're trimming your semiconductors and your Mag 7 names because they've run up so much. And it's honestly quite hard to do. So forcing the investor to take advantage of the benefit of diversification by having two separate stacks, two separate exposures that have diversification benefits, and harvesting that diversification benefit has been extremely valuable. And you're seeing more and more players enter into the space. AQR has stacked products. JP Morgan just came out with a stacked managed futures and stocks ETF. The Man Group just stacked their managed future strategy on top of the S&P 500. Obviously, our partners at Return Stacked ETFs do it very well. Wisdom Tree has a number of offerings in that space. Simplify is starting to do a similar concept with their CTA and stock portfolio. And so whether it's a CTA strategy or gold, for example, which is something we use often, you might say, I like the character. I think gold will have a positive rate of return over the next 5 years. I think it'll outperform cash, but I'm scared to put it against my equity benchmark because I'm scared that it'll actually underperform. So that's a perfect example of an asset that could be stacked on something else to still exist in your portfolio. But again, addition without subtraction doesn't make you have to pull further away from your benchmark and have tracking error by going further from your benchmark.
No, I like that. We're being additive, not subtractive. And I say that frequently myself. But this actually came up on last week's episode with Jimmy Lee, our CEO, and he was making the point, and it sounds like you agree, it's not enough for an advisor or a client just to buy the S&P 500. That is not being truly diversified. And I want to bring this out in the conversation for our listeners, because you're essentially critiquing and tearing down the old 60-40 portfolio. And so it sounds like, and we're going to pick on gold and Bitcoin obviously here, but it sounds like through the use of leverage, it is possible to have 100% exposure to both of those asset classes at the same time. So could you elaborate on that concept of leverage? Because, and I'm just, don't shoot the messenger, but many advisors would kind of balk or be, reluctant to embrace that kind of a strategy. So how are we thinking about that incorrectly?
Yeah, and I think a good example of this, there's a Wall Street Journal article that came out probably about 10 days ago that said, is 90-10 the new 60-40? I don't know if you saw that, but they were talking about 90% stocks and 10% cash. They're asking, is 90% stocks and 10% cash the new 60-40? Instead of doing 60% equities and 40% bonds, do you just do 90-10 and hold the remainder in cash? And Cliff Asness of AQR had an amazing rebuttal on Twitter to that and said it's not 90-10, it's 90-60, right? You just take that 60-40 and multiply both sides of that by 1.5. So the 60 in equities goes up to 90, the 40 in other, fixed income or other, however you want to bucket that, like risk off basket, goes to 60%. And so, yes, if you told me you were going to use leverage to get your clients to 120% equity exposure, I would say that is definitely risky, right? Because you're just adding concentration onto the same thing. But when you're adding diversifying assets to your primary source of risk, which is likely the S&P 500 in equities, it can actually reduce your risk. And we've seen that in real time. Our first ETF launched in October 2024. It's the 100% Bitcoin and 100% gold ETF, ticker BTGD. And we've actually had, even though it's a 200% exposure basket, 100% stock, Bitcoin, 100% gold, we've had less than 1-to-1 downside to IBIT. So 200% basket, but we have less than 1-to-1 downside to Bitcoin alone, because at least over the course of the life of the ETF, there's been a little more correlation in the last 6 months. The correlation has been in your favor. And so oftentimes when Bitcoin really falls hard, you see gold hold up. Now, this geopolitical event is a little bit of a unique environment, which we can absolutely touch on. But again, that's just a good example of why more leverage doesn't always mean more downside volatility. And if you're adding leverage that comes with diversification, mathematically, that's actually a much easier path to trying to generate alpha versus your benchmark than either trying to time that asset class and go above or below your benchmark, or trying to be a stock picker within that benchmark and trying to derive alpha from being a stock picker. And I'm not saying advisors should throw out trying to find alpha in stocks or moving their exposure to equity benchmarks. I'm just saying adding a third potential source of alpha that is more structural and less tactical can very well complement what you're doing in trying to generate that alpha around your clients' beta assets.
So, because you already hit on it, both gold and Bitcoin, and to be fair, we do have holdings in both those asset classes in our liquid alternatives models. So we're kind of preaching to the choir a bit here, but this is a big question. It might be a long answer, but hey, run with it. So gold has existed for what, 5,000 years, maybe more. And Bitcoin has existed for what, 17? We'll call it less than 20. So why, I'll tee it up. Why should investors own both?
Yeah, in as simple of a response as possible, scarcity. Gold mines at less than 2% a year. It's right around 1.75%. Bitcoin mines, at least now, maybe not 10 years ago, at a very low level of 0.86 basis points per year, less than 1% per year. You kind of have to just ask yourself, at what pace will paper currencies print? Historically, it's about 7 to 9% a year. Bitcoin today is very different than it was 12 years ago. 12 years ago, when we had a mining rate of like 15%, you had to knock on your neighbor's door and be like, you should like Bitcoin too, because supply is coming and I need someone to buy that supply. That supply is gone, right? So you don't need more people to like Bitcoin. You just need to wait for there to be more dollars in circulation, and then Bitcoin becomes a smaller percentage of the average portfolio's weighting. And, Bitcoin has evolved and tried to be many different things over the course of its life. Initially, it was almost like Ethereum, like a platform for transactions to be done on, and it's proven to be less efficient at that than some of the other cryptocurrencies. But its scarcity value holds true. And there's, in truth, what is truly scarce in our world today? You have energy, you have land, and you have assets that are deemed store value, like Bitcoin and gold, with low supply. And I think there's reason to have real estate, commodities, and scarcity assets like Bitcoin and gold in your portfolio. And gold, particularly out of the precious metals basket, silver, copper, these are used for economic functions. Silver is going into chips, your phone that you're buying. So a lot of the other precious metals will have a higher correlation to GDP growth, whereas gold, pretty much its entirety of its value is being stored. It is within its store of value tendencies. So over time, we believe will be much less correlated to broader markets than the rest of the precious metal baskets, that some of their value might be derived from store value and some of it might be derived from economic use.
Well, I love that, that explanation. Naturally, as a financial economist, demand and supply, right? Price is just the equilibrium between those two forces. And
if I could ask you, you have Bitcoin and gold. Do you rebalance between those two assets?
We do. And so one of the questions that we get, and this is a model that includes many other things like listed infrastructure. We've got some absolute return trackers in there. We've also got some CTAs for commodity futures trading and the like. But and this is the question: how do we manage the risk and the volatility of those two that you asked about? And we do it very simply. It's a naive approach through the position limit, and I'm sure you appreciate size and scaling. I think can be simple but powerful tools, and we rebalance on an annual basis, and that could change. We might do it on a higher frequency basis as the demand kind of ramps up for that model. But basically, it embeds what it does. It embeds a buy sell discipline. So at the end of last year, we were, paring down because of the natural portfolio drift. And now that we've kind of deviated below the position target or allocation, it forces us to buy into the weakness. Isn't that beautiful?
Yeah, no, honestly, I commend you for actually doing the blocking and tackling. That makes you truly take full advantage of the diversification in assets that are not just your pure beta. But I would say, honestly, you're probably a little bit more of an outlier than the norm. I find a lot of people who own both Bitcoin and gold, it's just a hard asset for them to rebalance, either to buy into weakness or sell into strength.
And when I say like position limit, I mean like 10%. We're not going crazy, right? We've got a fairly conservative client base. But I wanted to come back to that, and thank you for the question. But the issue of scarcity, and I recently penned something about, and this is just me as an economist trying to size and scale the broader space economy. And I guess it's be careful what you wish for, because if we were to tow a solid gold asteroid into orbit and started to mine it, and this is to your point, it could really throw a wrench in the works of scarcity. And I've often, until now, I've been, I'm still learning, but I've often used the Olympic swimming pool analogy when it comes to gold and its scarcity. So that could change, subject to further notice.
Yeah.
But I was going to ask you on Bitcoin, do you think it's graduated from, or maybe on the leading edge of graduating from being a speculative tool to more of a strategic asset class, the way we're discussing here?
So I think there's two steps to an asset class becoming that. One is it has to be a little bit boring, right? Like sometimes just portfolio management is just blocking and tackling between boring things. And I feel like some of the luster on Bitcoin has fallen by the wayside. I find that to be exceptionally bullish from my perspectives. And then again, it has to be adopted. And that really is, was initially hindered by everything from E&O insurance to firm policies. But the second you start to see Morgan Stanley has a Bitcoin ETF, they're coming out with an Ethereum ETF, I think also a Solana ETF. They're recommending, I think, 2 to 5% crypto allocation. BOFA's recommending a 2 to 4% crypto allocation. BlackRock's recommending a crypto allocation. Goldman Sachs is coming out with a Bitcoin derivative income ETF, right? So all these firms are slowly introducing this into their benchmark. I think, you're going to eventually see the 60-40 transform into a benchmark that includes, on a much wider basis, commodities and scarcity assets such as Bitcoin and gold. And so I think we're still very early in the institutional world adopting it. Look, these are two assets that have done exceptionally bad over the last 3 months. And I think I have very rational reasons for why they have underperformed in this period, which, if you'd like, I'm happy to go into. If you look at October till today, there's two sides of the coin. There's stocks, productivity growth, earnings, increased forward guidance, and then there's the interest rate environment we find ourselves in. If you look at U.S. Treasury bonds, Japanese Treasury bonds from October till today, the yield on further out on the curve has done nothing but go up, right? So you have two assets that don't have any natural form of income, where a risk-free duration asset is increasing in yield. That's obviously going to cause a little bit of pain in the short run. And then the other side, especially in the last 6 weeks, this whole market in the last 6 weeks has been from productivity growth, from what AI could do for our economy from an earnings perspective, not just from the Mag 7 and the semiconductor space, but also how it'll apply to the rest of the companies in the S&P 500. So you've had massive innovation, productivity growth, earnings growth from this new technology, and the cost of financing has gone up. And that's been a little bit of a perfect storm for two assets that have no innovation, have no earnings, and have no yield, right? So it's been a little bit of a perfect storm. I'll also say that specifically for gold, the entities around the world that have increased their allocations to gold the most are actually central banks. Central banks have stopped buying bonds, treasury bonds, U.S. treasury bonds, bonds from other countries, and have gone back to their days of the 70s and 80s, where they're putting a larger percentage of their balance sheet in gold. Some are also extending that to Bitcoin as well. It just so happens that a lot of these economies are also oil importers. And they're looking at their balance sheet and they're like, okay, we're now at 35% gold, maybe 40% gold. It's gone up 30% in the last year. We now need to figure out how to make room in our budget to buy oil. So they trimmed the asset that did the best. The country that's been most public about this is Turkey, but we expect similar things have happened in China and other emerging market economies that are oil importers as well. Doesn't change their stance on gold. If anything, it solidified their investment thesis on gold. They were like, look, we invested in things 12 months ago. Bonds went down, gold went up a lot. We trimmed the asset that went up the most, just like you. They were like, well, now this is a little bit higher in allocation than our target. So let's trim this and buy some oil for our economy. And it's kind of as simple as that. And if that hadn't occurred, I think we'd actually be still at new all-time highs in gold, and we'd be in total gold mania. But it's ironic that the institutions that adopted this asset class the quickest over the last 5 years were forced sellers. And that's what's dampening this market. And their viewpoint on the asset hasn't changed. It actually worked. It's been validated. They just did the prudent thing, like we talked about. They took advantage of diversification and they trimmed the asset that did the best. Doesn't mean they're not going to be in an accumulation phase of those assets in the future going forward. But it just gives some context as to, especially in the early days of the war, like Bitcoin was outperforming gold in the early days of the war. And I think people were like, wow, that's a head scratcher. I didn't see that one happening. And that's because there was just more to sell on central bank balance sheets of gold than there was of Bitcoin.
So, as I think through this and I listened to you talk, and I got this question. I'm always on the other side of the question, so I'll try it out on you. But it seems to me, like last year, I guess it was up until October, and I wrote about it then. We had a blow off top in gold, so that part of the portfolio was lighting up, and around the same time, Bitcoin was doing its thing, and things have completely changed, and now we had a massive crowding in the tech semiconductor momentum factor, and I warned about that. And similar story here, David. I mean, we have position limits in our quantitative stock selection model as well, and so we've had to do trimming pretty much everywhere for these reasons. And it's not because we hate semiconductors; we love the companies. It's just risk management, right? That's what we do as responsible stewards of capital. But what do you think? I had my answer, but do you think that diversification is actually starting to work again here?
Yeah, I don't think it ever failed. I just think that when people were constrained within the context of a 100% portfolio, diversification meant taking an active bet against your benchmark, right? So it would say, oh, let's look at managed futures. Like sell 10% of your equities and add to managed futures. Well, if managed futures doesn't outperform equities, that's going to be a drag. Even if it adds diversification benefits, it's going to hurt your top line. But then stacking it on top, the two combined will give you more upside than just stocks alone, and in theory, potentially even less risk than that full stock portfolio. So I think we've been constrained within this 100% construct that diversification comes with underweighting something. And now you don't have to underweight something to have that diversification. So I think if these tools were around for over the last 10 years, no one would be talking about the fact that diversification is dead. But the fact that you have to underweight your benchmark, which traditionally means underweight equities, to add in diversifiers, it hasn't really worked. It hasn't really added a lot of value. But because you can now add it without subtracting against your benchmark, that's where I really see the growth of this category. But yeah, I mean, you're seeing diversification play out in real time. It's not just the semis, it's the energy space, right? Like think about people who held on to energy stocks or a commodity basket for the last couple of years. They were very warranted and rewarded in that in the early days of the war. But again, you still have to do the difficult, emotionless rebalancing and say, okay, the hot potato, this popped and this fell, so I'm going to trim a little bit of this and buy this, which might look like you're trying to market time from the outside, but I know based on how you outlined your investment process, like there's no timing in that. It's very structural. Okay, we had a 5% allocation, it's floated to a 6% allocation. Do we bring it back down to 5? Kind of as simple as that. But I don't think diversification has been dead for a while. I just think that it's more costly when you have to underweight against your benchmark to add diversification.
Well said. And I want to get to income because I think that's one area of interest that we really haven't touched on quite yet. Yeah. But before I do, maybe I'll just ask you some like kind of general product and industry level questions. I really should have started there, but that's okay. We're humans and we're messy and organic. But and you mentioned it earlier because you launched your ETF, and I want to know from your perspective, what's like the number one or best, smartest thing that you've learned from that experience, and how even in conversations like this, you're kind of communicating and messaging the goal and the objective there, and maybe this is a two-parter, maybe at the industry level, because you were talking about this too. Are we in the early or later stage of ETF disruption? Meaning, and you were mentioning all the players. Has the industry become kind of overcrowded?
Yeah. So I'll preface that question with saying I'm a 20-year veteran in the ETF space. I started off as an allocator, managed about $2 billion of ETF model portfolios for 6,000 independent advisors. And then I spent 11 to 12 years I was the fourth partner at Tidal Financial Group, the biggest ETF white labeler on the planet. So Tidal now has, probably like 70, 75 billion, 400 ETFs, 80 ETF clients. They're the back office and executions and ops of a lot of even multi-billion-dollar ETF conglomerates. I remember the first ETF conference I went to was in January 2008. And there were about 350 ETFs in the landscape, and everyone said, yeah, but all the good ideas are gone, right? So fast forward to today, we have over, I think, 4,600 ETFs, significantly more ETFs than stocks. There's definitely a bit of ETF slop out there, right, where people are just kind of throwing stuff against the wall. But there's also what I believe to be the most innovative investment vehicles to date available to your average investor being created in the ETF space. One of my reasons why I wanted to leave Title and start Quantify Funds was for a lack of participation in ETFs from the hedge fund world. And, ETFs are cheaper, more tax efficient. The tax efficiency is huge and more liquid than any other alternative investment wrapper you can find. For those that don't understand the tax efficiency of an ETF, in most cases, you can actually take a position within the ETF that has a gain, remove it from the portfolio without causing a taxable event. There's no other taxable wrapper in this world that allows you to do this. And it just blew my mind that more hedge funds weren't coming to the ETF wrapper. And that's what we built Quantify Funds to do. We call it hedge fund ETFs for Main Street. And for example, as you alluded to with our income stack lineup, still using the stacked concept that we launched in January, we brought what we believe to be the best derivative income options team in the entire ETF space to the wrapper through this. And that's really our plan for our next couple of years, is finding true hedge fund-like talent, creating a product that makes sense for today's markets, that will be in demand, that takes advantage of their talents to add a little bit of alpha beyond what you could do without them in a very tax efficient manner in this ETF wrapper. And so, yes, there is a lot of quote unquote ETF slop out there, but there's also some of the most innovative things you've ever found being launched in the ETF wrapper. I always like to say, like, if you don't have one ETF in your portfolio that was launched in the last 3 years, you're probably missing out on some of the best innovations built specifically for today's markets. And oftentimes that's going to come from a smaller manager, because it was so obvious BlackRock would have done it 15 years ago. And we saw this time and time in Title. And I remember late 2021, beginning of 2022, we launched a couple ETFs with good partners that had negative duration in them. That was right before 2022 when interest rates spiked, right? Those were phenomenal hedges. Those were all vehicles that were under 1 year old. And so I think, yes, there is definitely some slop to wade through, but within that slop, there's so much value in truly unique strategies that are being built. Flows don't always immediately chase the best strategies. Sometimes they chase the best marketed or the best marketing strategies. But as to like how we're getting our message out there, I think one thing that's under considered in the ETF space is you understand your product, but you have to continuously evolve your messaging to hit the points in the marketplace that helps the marketplace understand your value add in the supply chain. And that's something that I think a lot of people think they know exactly what their correct marketing story is, but it's something that always consistently has to be honed and evolved to really convey the message that you're trying to make. So for example, for us in our income stack lineup, which is a more advanced, more complex, more active version of just stacking, we are doing derivative income options exposures on both sides. We have some downside hedges. We have a truly active mandate. Sometimes we're short dated options. Sometimes we're longer dated options. But that, being able to do that in ETF wrapper, while it's very complex, trying to convey that in a very concise message. For us, the first message we give is you don't need to choose between total return and income. A lot of people are used to the JEPIs of the world and traditional cover call ETFs, and they say, great, you will generate some income. You're going to underperform on a total return basis. Each one of our legs of these stacks on the income stack side is designed to keep up, if not outpace, the total return of each underlying asset. So we're building these things to give you derivative income, but also give you upside on the underlying asset and actively harvesting volatility, versus what our competitors are doing oftentimes is a single option approach. We do monthly calls, we do put spreads, we do zero DTE, and then their exposure floats over time. If you do a cover call strategy, you might have a beta of 0.75 on day one, meaning if the market goes up 1%, you'll go up 0.75%. If the markets trend upwards for the next 2 or 3 weeks, your beta might fall to 0.4, meaning if the market goes up 1%, you might only go up 0.4%. That's not on the prowess of a manager. That's just a random walk. So we flipped that and said, you know what? the exposure should be fixed, and how we harvest volatility in premium, that is where the source of alpha should come from. I always like to look at 2025. 2025, zero GTE did exceptionally well. Why did zero GTE do so well last year? Well, let's look post-Liberation Day. Everyone expected volatility in the future, but there was very little volatility realized on a day-to-day basis. That's the perfect example period for zero GTE. Now looking to 2026, vols all over the place. It's spiking, it's crashing, it's spiking, it's crashing. We've been through basically 4 or 5 different vol environments. There are times this year when being in a little bit of a longer dated option strategy has been supremely beneficial versus zero GTE, versus like in the last 2 weeks when vols collapsed. Maybe it's actually not worth it to harvest a lot of premium, and the premium you do harvest should be shorter term. A good example is right now we're harvesting the least amount of premium in Bitcoin that we have in history. The IV, implied volatility, future volatility of Bitcoin, is the lowest it's ever been. It started to pick up in the last day or two, but in general, it's still around that like 1 or 2 percentile, right? Should you be leaning into harvesting a lot of volatility when it's priced cheaply further out and expensive on a day-to-day basis? Like, probably not. But a lot of the derivative income strategies out there will just kind of formulaically say, we're trying to hit a 10%, 12%, 15% distribution target up. Vol is low, we have to harvest more volatility. And they're kind of doing the exact opposite. They're harvesting less volatility when it's juicy and more volatility when it's low. And that's because they're not constantly rebalancing and they have to worry about their exposure. So harvesting less on the way down gives them more upside. Whereas we're rebalancing every single day, probably about 4.5 out of 5 days out of the week. And that allows us to both harvest volatility when it's juicy and keep our exposure, because we're constantly rebalancing to keep that target of that exposure. And one of the things we're doing that's exceptionally unique in this space, and I think truly revolutionizing transparency in the ETF wrapper, there's some firms that will email or post their trades from the day before. We post our trades on our website, but we went a step further in the last, call it about 10 days, and we actually got a compliance approval on, we will now post on Twitter trade rationale for the day before. So you'll see on our Quantify Funds Twitter account, we'll say, hey, these were the trades in our income stacked ETFs yesterday, and here's the rationale for why we did each trade, and really trying to provide full transparency and to see what a true hedge fund like derivative income desk and manager looks like and their logic on day-to-day basis.
Well, we'll have to get our compliance departments talking, because we haven't been able to figure that out yet. But
Yeah.
We like to say it's better talking about vol and downside protection. It's better to have the protection when it's cheap and not need it than need it when it's expensive and not have it. So, but everything you're just saying generally, just taking a step back about ETFs as products resonates, and I've been a long time early adopter of these vehicles since 2000, so 26 years and counting, and wrote a book about it and everything. So I get it, and that's some of the reasons that you mentioned. There's many benefits of using these products. One is, personally, I love the ease and convenience of thematic investing. As a strategist, I don't have to sit here and pick stocks. So that's great for me, unlike our CIO, who's very good at doing that. So we've got the macro and the micro. But also, to your point, very strongly, and this is well taken as well, the tax efficiencies. And that's exactly why we serve those models up in our suite of offerings to advisors and their customers. But I wanted to ask you about some of the things that you were saying about incoming. It's a timely conversation, David, because we're actually we're always looking to improve, and we're taking a look at our income models here. But from your perspective and your experience, what do you see? What's the biggest mistake that advisors make when they're evaluating income ETFs, and what role, as you say, should options play in this kind of broader income strategy?
Yeah, I think the biggest mistake when assessing these strategies is not properly quantifying their risk levels, right? And that could be your traditional cover call strategy that has 75% exposure, or some newer strategies that are targeting, there's some out there that have 1.1x exposure, some that have 1.35x exposure. And they tend to first and foremost analyze it on just a total return basis, not on a risk adjusted or beta adjusted basis. So really understanding, is this vehicle trying to create alpha? Is it creating alpha? Is it just a lower beta version of the benchmark, or is it a higher beta version of the benchmark? And starting from that point, and that's where you'll see with the downside protection we have built into these strategies, with the alpha from the volatility side, we've actually been able to generate real alpha versus our benchmark in the space, whereas most managers out there aren't even truly trying to generate alpha. And if you have a $30 billion cover call strategy ETF that just each month is just rolling over calls, it's really easy for the market to front run it. And it makes a lot of sense that like a strategy like JEPI had actual real alpha when it was smaller. Now it's so large, and the market has reverse engineered their trades, that there's actually negative alpha that's been generated in the last couple of years relative to broad S&P 500 benchmarks. So trying to figure out, like, are you just getting a passive exposure and that's fine, and that should be a cheaper ETF, or are you actually in something that could generate and garner a potential source of alpha? And I always like to say, if it does just a single option strategy, the odds of it creating alpha are low, right? Whether it's put spreads, cover call, this or that, like if it were that simple and could be indexed and generate that much alpha, the hedge fund world would arb that alpha out immediately. And it's a lot easier to, for example, make a judgment call saying, I think Bitcoin volatility is cheap, versus saying, I think I know the direction of Bitcoin over the next 4 weeks, right? One is a lot of easier of a potential source of alpha in your portfolio than the other. And I also think looking at like distribution rates, like are they over distributing for their assets? We have these 200% stacked derivative income strategies. We pay 18 to call it 23, 24% distributions. Sounds really high, but the unlevered distribution rate on that is actually quite reasonable. We did that intelligently. We want to make sure that these are vehicles that their NAV alone can appreciate over full market cycles. I think what retail has done incorrectly in the space is, at least in the 1.0 fashion, flocked too much to just like the max distribution ETFs, 40, 60, 80, 100%. Listen, like if any single strategy can generate 65% returns a year and warrant a 65% distribution, the hedge fund world is going to be all over that. They're going to arb all of that out. So having a reasonable distribution rate, I think, is really, really key, and making sure you have enough upside. I think looking at the up capture ratio versus down capture ratio, as well as the risk levels versus your benchmark, I think there just needs to be a higher level of due diligence on this space as a whole. And oftentimes people just sub out, well, 1 for 1, we're going to sub out this and put a cover call strategy in instead of the S&P 500. You just took some chips off the table. If your beta is 75%, you just sold equities. Your ability to outperform and underperform is going to be fully based on you just took chips off the table. And maybe that was well timed, and maybe that was improperly timed. But I think truly assessing the beta, the risk level, and the up and down capture ratios of these strategies versus their respected benchmarks needs to be considered. And in general, there's a lot of benefits to this. It's a lot more tax efficient than the structured product world. If you were right, like what's the point of having an alternative investment in your portfolio if when it does its job and has alternative returns to broad beta, you can't immediately harvest that and rebalance it? Structured product world, okay, you have some penalty for trying to close this out early. Maybe we'll give you your money in a week. At least how quick markets move. You need to make that decision on the drop of a dime. Be like, okay, this is an extreme. I'm going to trim this and rebalance back to my rest of my portfolio. So it just makes so much more sense in the ETF wrapper than it does in a hedge fund format or a structured product format. You put in a redemption into a hedge fund, they'll say, okay, for the course of the next 18 months, you'll slowly get your money back. You're like, listen, I'm asking for the redemption because I see other opportunities in the marketplace today, not in 18 months. So I think really understanding, first and foremost, what is the risk level of your derivative income strategy. And, I think some things are definitely being too over-engineered. I'm not a huge fan of the auto-callable space. Essentially, you're just selling puts on broad asset classes in different magnitude. And if you're going to have something that caps the upside, you want something that is going to protect the downside. And while auto callables might be fine if you don't breach the barrier over the course of a couple of years, you're still going to, if you look at like an auto callable S&P 500 ETF, like over the course of this geopolitical conflict, it tends to go down just as much as broad equity markets. Yes, you're still getting paid this premium for the risk you're taking, but it's not like, oh, great, equities are down. This is not down and I can redeploy off of it. It's still down. That's why we really focused, at least in our first launches here in the derivative income space, on giving you that upside. Like, don't sacrifice your upside for derivative income. And the total return of our products should outpace, A plus B minus the cost of financing, whether it's ISSB, which is stocks and Bitcoin, or ISBG, which is Bitcoin and gold. Our next one we'll launch will be ISSG, which is stocks and gold. So add these assets to your portfolio without stepping too far away from your benchmark, and do it with this active mandate of, it's much easier to derive alpha from trying to find the opportunity in the options market. Is the skew too high? What is the IV versus RV? What are the volatility at different tenors, et cetera? And using that as the source of alpha, which I don't see many managers out there in the space competing to that level of expertise as what we've constructed here.
So that's great. Thank you for that thorough answer. Help me. This is more of a kind of a mechanical product question and less of an asset allocation question. But these like 1.5x, 2x leverage products, how do they actually work? For example, and I'll make it very simple. I'll give it like an S&P 500 example. As a long-term investor, why wouldn't I just put all my money in a 2x S&P ETF? Like, how am I thinking about it incorrectly? Is there a holding period constraint? You get kicked out and you have to keep rebuying it? Like, help me get my arms around that one.
Yeah. So first, how do they get the leverage? They get the leverage through futures, swaps, or options traditionally. There's nothing wrong with a 2x leverage ETF. The issue is it puts a lot of responsibility on the allocator to almost become a day trader. You have to reposition that in your portfolio 3 or 4 days a week, because in a 2x S&P 500 vehicle, both legs are going to go up together and both legs are going to go down together. There's no diversification that could happen within. In its simplest sense, what is stacking is like, okay, we take the onus of that daily rebalancing off of the allocator and embed it into the ETF, and we're still harvesting diversification benefits between the two. Our income stack lineup goes a little bit further. It has some added downside protection. We can go into details on why and how that is. But a traditional leverage ETF it needs to be repositioned 3 to 4 times a week in your portfolio. Right. And if you do that, you can achieve your desired 2x over time. But if you don't do that, you're likely to experience a lot of volatility decay. And that's the first and foremost thing that portable alpha return stacking does. It tries to minimize vol decay. And so you might still have some vol decay. You might still need to do some rebalancing, but maybe it's like once a month, once a quarter, and it doesn't make you have to be a daily trader in your portfolio or your clients' assets. Then we went to even a step further with this income stack lineup, where we've actually outperformed any vol decay. You can just kind of look point to point, asset A plus asset B minus cost of financing, which I don't think people truly realize how revolutionary that is, that we've been able to add alpha and put this like downside protection to outperform vol decay. But it's hugely valuable to clients to be able to do that, to have a leverage ETF that is going to have very little, if not no, vol decay. And they can get a natural form of leverage in their portfolio. They don't have to worry about margin calls. We think this is really like not even the 2.0, but really like the 3.0 of what we're seeing in the derivative income space. And that's where I meant there's still a lot of white space. Like, we are talking to so many talented hedge fund teams that, dollars in hedge funds haven't really increased in the last 7 years. It's all at the same 10 firms. There's a lot of glass ceilings talented people in these firms have hit. They've broken off to create their own small little firms, but they're not getting the type of assets that the ETF world is getting. And so introducing that talent into the ETF wrapper with the added layer of tax efficiency, I don't think you can compete. And yes, maybe if you're doing esoteric, supremely illiquid investments in the hedge fund world, or your holding period is 15 minutes or under on a specific stock, like, yes, that still deserves to be in a hedge fund wrapper. But everything else should be moved over to the ETF space. It's just a question of, will you do your strategy in ETF wrapper, or are you going to be second to market in that world and someone else is going to beat you to it?
Look at that. I teed you up and you knocked it out of the park. That was a better question than I thought. Maybe, and I want to give you the last word, but I'll set you up with another one because I think this is a natural question that begs asking. If you had $100 million and an advisor was asking you, what would be your highest conviction asset allocation, let's say for a moderately aggressive investor?
Yeah, I mean, first and foremost, just very boring broad equities. You need to have exposure to equities, including international equities. But then I would be looking for scarcity. I look at my portfolio primarily as two lenses. You have productivity assets, and you have scarcity assets. So I sound a little bit like a broken record here, but gosh, if I had $100 million, the one thing you want to protect is your purchasing power. You don't care about like outpacing, just the S&P by itself. You want to make sure that your asset growth is outpacing inflation and protecting purchasing power in the future first and foremost. And that's where I think the concept of these scarcity assets really, really adds a lot of value to that portfolio. So I'd have at least a 5% Bitcoin allocation, at least a 5% gold allocation. I think where we are today, even treasuries and tips are starting to look attractive again for the first time in a number of years. I think CTAs, I think carry strategies, yield carry strategies, all these things have a place in your portfolio. The question is like, what is your actual appropriate benchmark, and set your equity at that benchmark and then just build around it with everything else. But yeah, I'm first and foremost, I'd be, how do I protect my purchasing power with this massive wealth that you've created? Especially when just sitting in your savings account, your purchasing power is just going down every single year.
Well, that's great. I think that's a great place to kind of wind down. We did it in under an hour, 7 minutes to go. I'll give you back the balance of your time. But look, this is great. I hope you'll come back on in the weeks and months ahead and give us an update on your progress.
Would love to. We have some new things in filings that will go live in the next probably like 120 days. So excited about that. And, I think this whole moment of this SpaceX IPO, all the LP cash that gets freed up, all the employee equity pools gets freed up to be redeployed and used. Even just alone from that, just the productivity growth and the inflation of markets we've seen, there's been so much wealth creation on productivity. I think the yin to the yang of that is the scarcity trade. All these people are going to be having this conversation. Let's say you have $200 million in SpaceX IPO. If I were you and I was their advisor or that individual, I'd be worried about my purchasing power. How do I get some exposure to these assets that will sustain their value because of just constrained supply?
That's great. Thanks very much, David.
Thank you so much for having me on.
Come and dance on our floor. Take a step that is new.